Hey, good morning, Ralph Mendez. How are you going to protect cash when you go into business? How are you going to protect cash? Have any of y'all ever been down 35 towards Dallas and in Waco on the east side of 35 is this beautiful building called the Collins Street Bakery? I mean, look at the beautiful pastries they make. And I mean, probably last year, I think they packed and sold over 1 million pounds. Those cakes of theirs are sold all over the world, these fruit cakes and things. Um, but in a few years ago, right here, I think these things are shipped all around the world. You know, um, they're going to make a film about them because Hollywood film coming out soon based on the Corsicana Fruitcake Shop scandal. They have revealed to have stolen nearly $17 million from the business. So Will Ferrell and Laura Dern, I believe, are going to come out in this movie. It's amazing they even survived. So the comptroller. So what happened? How could they steal 17 million in cash? One person stole that much. Um, I don't think my business would have survived if somebody stole 17 million. And it wasn't that difficult. So let's start on this homework. The first one is the cash register shows 550. Now let's put on the third line. $550 of sales. In the cash in the register is 586. So they don't match. They're off by $36. So is it a debit you need of 36 or a credit? Well, you need a credit, so they add up. 550 and 36 is the 586. And what is it? Well, you have a whole new account called cash short or over. In this case, the cash, what is it? Are they short of cash or over? They're over. There's more cash in the box than what the sales show through the cash register. So it's over. So if this new account has a credit balance, what is it? Asset, expense, dividend, liability, revenue, or capital? It's additional revenue because just because the register doesn't show that, the government says, well, you got extra cash, so it must be a revenue. So let's try the second one. So now in this case, the cash register shows how much? 1102. And the sales off the register show 1136. So what's the difference? Do we need a debit of $34 or a credit? You need a debit in this case. So now cash short and over has a debit balance. So in the previous one, it had a credit balance, and now it has a debit balance. When it was a credit, it's a revenue. So what is it over here with a debit? It was a credit here, and in number 2, it's a debit. So what is it here? Still a revenue? They're short of cash. It's a cost of doing business or an expense. This is the only account. That changes the flavor or animal it is based on whether it's a debit or a credit balance. Here it's a credit, it's a revenue. Here it's an expense, a debit balance. So that is the new account called cash short and over. Now let's go on to number 4. These are petty cash accounting, but we're going to do number 4 with a shortage. So petty cash. So the company establishes a petty cash fund. So it takes it out of cash. Now, do y'all have a petty cash fund where you work? How much is it? 310. Well, do any of y'all worked in the service industry ever? In that case, at night, have you ever run out of lemons, limes, avocados, lettuce, or tomatoes? And then what did they do? They gave you some cash to run to a grocery store to buy these lemons, limes, avocados, whatever it is you needed for the restaurant, rather than tell customer, oh, we don't have any. Well, they took it out of the petty cash fund, and then you have to go purchase it, bring it back, and give the receipts. So right here, you got to turn in the receipts, and it needs to add up to the cash you took. So in this case, they had transportation in for some inventory, some postage expenses, and miscellaneous. So merchandise inventory, and they paid postage, and they had some miscellaneous. And the cash, so in this case, so how much do those debits add up to? Did I get them right? 57, 73, and 117. How much does that add up to? So these all add up to, let's just say 247. That's the receipts. The receipts add up 170, 80, 230, 240. Okay. So now how much cash is missing out of the box? You set it up for 310 and the fund shows $59 left. So if you started with 310 and there's 59 left, how much did you disperse? Well, 251. And in this case, the cash missing is 251. You have receipts for 247. So you're short $4. Does everybody understand that? So you're short because it's a debit. You're short of money, and that's how we would record it. So you have to put the receipts here, record how much cash is missing and whether you're short or over. Now, the next one is they want to just increase it. The 310 isn't enough, so they want you to increase the fund to 360. So that's just an extra $30, and we increase the petty cash. And we take it out of cash again. And over here, look here, it's not out of the petty cash. You're replenishing the petty cash fund with the cash account. In here, you're just making it larger. Now it was 310, now it's 30 more. So now it's oh, I put the wrong amount, didn't I? 310, and they want to be 360. So how much more is that? That's $50 more. All right, so now it's up to 360. So let's just say it's not part of the problem. Let's just say they wanted to get rid of the petty cash fund. They don't want it anymore. They would put it in they would put it in here in cash. It would say cash 360. Is that how much they want? Yeah, 360. And they would credit petty cash. Does everybody see that's how you would close out this account? All right, so you would close it by that. That's in case you wanted to close it, right? So you've increased it. What about if we wanted to close it and get rid of it? All right, let's check our work. So the petty cash starting over is your new account. The petty cash fund is a control. Okay. All right, so let's go on to the next one. What are we going to do next? It wants bank reconciliation. So one of the things that Collins Street Bakery could have done is have an independent person come in and do a bank reconciliation of the bank accounts. Now, in this case, I'm showing you University of California, San Diego, and right here it says, good afternoon, it's Wednesday, March 24th. So here it is, a California university, and it has internal controls. So everybody exercises internal controls. And here they actually list their practices. UC San Diego transacts thousands of dollars in over-the-counter business every day to ensure you protect the university assets. We follow these internal controls. So this is what you want to learn. The question is, how are you going to protect cash? So you need to learn about internal controls. And we have some wonderful sources to guide you. Best practice to have different people, potential consequences if the duties are not. And I wanted to show you down here. Your reconciliation activities confirm that you've recorded a transaction correctly. Perform monthly reconciliation of the cash receipts and a bank account. So you compare them to what your ledger has to what the bank says you have. Compare receipts, record cash receipts and received counter. So this is perhaps one of the things, that maybe Colin Bakery didn't do. I don't know. But the bank reconciliation is what you're learning next. So here's an example of it. The bank statement comes in and says, oh, you have 50,700, but your ledger only shows 47. Well, how is that possible? To have $3,000-4,000 difference. That's why you do a bank reconciliation. And you're going to have 50 plus and minus things and 47 plus and minus things, but you hope the adjusted balances, and then you have to adjust your books to accurately reflect that. So let's go on here to a bank rec in Google Docs. The bank says you have 9,000. Your ledger shows you have 7,740. What's the next thing? A pending payment. Maybe you set up an automatic bill pay. Well, you already deducted it, but the bank records don't know that. So that's a minus on the 900 payment. And then maybe you used your debit card as a credit and takes a little longer. So a debit pending of 200. So there's another minus 200. But the bank doesn't know about them yet. You've set up an automatic bill pay or the debit card uses a credit. Now, the bank charged you $20. So they don't call you and say, hey, you owe us $20. They just take it out of your account. But your ledger doesn't know about that. So you got to subtract those $20 off your ledger. Then the bank collected a note for you. So somebody wired them the money, but your records don't know that the bank collected money. So you got to add the $180. Look, the adjusted balances match 7,900 and 7,900. That's what we were after by reconciling. And maybe if companies would have performed this, maybe they'd find some discrepancy. And that's probably very true, because the way the person stole the money at Colin Bank, let's just say he made a credit card payment of $10,000. Well, then he would void that in the accounting system, and then he would make a check of $10,000 to a legitimate vendor, but then he never would mail that one. He just mailed the bank one for his credit card, but he wouldn't mail the one for the vendor. So, but if somebody would have checked, they might have found and said, hey, look, this went to somebody's Visa card or credit card, and it didn't go to that vendor. That might have showed up, but it's probably the same person. They didn't have a control. Okay, now your record shows 7,740 and it needs to be 7,900. So let's look at this. Your cash needs to go up by 180 and then down by the 20, and then it'll match this. So you have to make an adjusting entry. Well, where'd the 180 come from? It came from a note. Somebody owed you $150, and the other $30 is interest revenue you made. Well, what happened to the bank? Why did the $20 go out? Because the bank charges service charges. So these two adjustments or adjusted entries, you put them in your system, and your cash is going to go 7,740 plus this 180 minus the 20, and it'll match this number. So not only after you do the bank rec, then you make adjustments to adjust your cash so it goes from 7,740 to the correct amount. In your bank, which is an independent third party, very honest, they're a fiduciary, so you're trying to match to their records. All right, now let's see if we have something else. What's next for us? So here, deposit in transit from a customer. So for whatever reason, you put it in the night depository, they mail something to the bank. So the bank does not know about it, and it's an addition to the bank records. And no, you don't make adjustments for the bank. You only make them for yourself. Bank service charges. Well, the bank already took the money, but our ledger doesn't know about it. And it's going to be a subtraction from our books. And yes, we have to tell our records that the bank charged us money. Interest earned on deposit in banks. Well, that needs to go on our records. And it's an addition when we make this interest. And yes, you got to make a journal entry telling where the money came from. All right, so there's the bank reconciliation. And what the homework's going to make you practice several times. Bank rec, and then make the journal entries. So 4 or 5 problems making you practice. Now here, it wants you to identify the internal control that was violated. Well, what are internal controls? Now, later on, you have a wonderful resource to go to. It's called COSO.org. So the Treadway Commission, Mr. Treadway was one of the head of the Securities Exchange Commission. And they started this committee in the 80s, 1985, because some abuses and some failures in the 80s. So the Congress wanted to know, hey, well, why are we having fraudulent activities? And they named it after him. And then, so it's been around. It's been around now. Look at this. It was 92, it got established. And now in 13, it got updated. So here's a resource you can go to in a few years. Look right here. The majority of U.S. publicly traded companies have adopted this framework to do this. So if do you work for a publicly traded company that's subject to Sarbanes-Oxley? So it's a compliance that you select an internal control framework. And the majority of the companies have adopted the COSO. All right, so right down here is the image of it. So you can go to this later when you need to set this up for your company. The 5 elements: control environment, risk assessment, control activities, information and communication, in monitoring, and operations, reporting, compliance, and the entity level, division level, operational unit, and the function. And we already saw that here, University of California, San Diego even has these internal controls. They're not publicly traded, but look, they're putting in internal controls, separation of duties, security of the assets. They want to protect their assets. So wonderful things companies are doing, and that's how you can get help. All right, let's see what's next. Okay, no, that one's not next. So here, let's go back to the homework. So what principle was violated? An employee was put in charge of handling cash. The employer later stole cash from the business. The company incurred an uninsured loss, $184,000. Insure assets, establish responsibilities, maintain records. Well, that's what it's asking you. You need to bond your key employees so the insurance company can handle that risk and help you not sustain a loss of almost $200,000 and major problems. There is $500 in the cash missing from a cash register drawer. 3 sales clerks share the cash register, so the owner cannot determine who's at fault. Well, what's happening there? Insure assets, bond employees, establish responsibilities, maintain adequate records. Well, to me, you got to separate, but establish responsibility or maintain adequate records. I'm going to say records just for right now, because maybe they didn't check who comes on when they came off. But so I'm going to try that. Was it responsibilities? Okay. 3 different sales clerks. So the salesmen are going in there. So an employee stole thousands of dollars worth of equipment over many years. It took years for the company to discover the fraud because the accounting records were rarely updated. Establish responsibilities. So maybe this is maintaining accurate records. And I'm going to change this and maybe to establish the responsibilities and say, no, there's not going to be 3 sales clerks going into cash drawer. Only one of you are. So let's just see how we did here. All right, so very good. We did okay on that. So one more homework problem here. Spectre has all these assets: $13,000 cash, a bond investment due in 20 years, $10,000 treasury bill due in 1 month, a 3-year loan to an employee. They have currency and coins. Well, what counts as cash and cash equivalents? So first off, let's talk about this, cash and cash equivalents. So here's Investopedia, and that's a really good resource for this. Cash and cash equivalent refer to the line item on the balance sheet that reports the value of a company's assets that are cash or can be converted to cash immediately. They include bank accounts, marketable securities. Okay. All right. Now, what else? Commercial paper, treasury bills, short-term government bonds with a maturity date of 3 months or less. 3 months is the time frame. 3 months. So now short-term government bonds, T-bills. So let's go here and look at T-bills. Here's the treasurydirect.gov website, and I've clicked on T-bills. So it talks about T-bills. They're sold and ranging from a few days to 52 weeks. A few days to 52 weeks. So right here, which one of these, they're issued for terms of 4, 8, 13, 26, and 52. Which one of those is a cash equivalent? The time frame's 90 days. 4 weeks less than 90 days, 8 weeks less than 90 days, 13. So the 4 and the 8 week, because 7 times this would be what, 91? All right, so these two are considered cash equivalent and these are not, all right? So that's what they're talking about. What do we put inside of the cash equivalents? Commercial paper, lending between companies, T-bills, short-term government bonds, 3 months or less, marketable securities, money market holdings. So let's go back to our problem. Checking account? Yep. Bond investment 20 years? No. 10,000 treasury bill due in a month? Yes. Loan to an employee for 3 years? No. $3,000 of coins and currency? Yes. Accounts receivable? No, that's an accounts receivable. So 26,000, check your work. All right, so I sincerely hope this was a help to you, work on your homework, but also gain an understanding. And later on, the big question is, how are we going to protect cash? Now, let me see. I think I had 1 or 2 other pictures I wanted to share with you. The CASO framework you can refer to. And just because it's publicly traded companies doesn't mean you can't use it in your organization, right? So publicly traded companies, fine. But if you're a little company, you know, I was just 200-300 employees, but doesn't mean you can't adopt these rules. Okay, now let's talk about these controls. Where are the controls at? The cash register is a control. You want the money to get in there because if the register says a sale took place, then they're going to know this money's missing. See? And then on top of that, the cameras are looking at the cash drawer in the cashier's hands. So next time you go to a store, look up and see if you see a translucent acoustical tile or see if you see a camera around shooting at the people's hands. You see, they're trying to have the cash drawer recorded. Now, a lot of times with debit cards and credit cards, you're not, but you still have to have these things. Cameras on the drawer, cameras on the drawer. So now, if you've worked as a cashier, you probably got written up if you were missing more than $10 or $15, $20. And then after a few times, if it keeps happening, they probably move you to another area. Hey, you're a wonderful person, good employee, but you're not good with counting cash, protecting it. So let's move you to another area. All right, so very important internal controls. And I thank you for coming today, and hopefully this helped.